Hello all. In the previous retirement planning series video, we had talked about mutual funds versus NPS as different forms of investments which suit different investment styles and investment goals. Now, in this series, we are going to talk about two very important parts of your retirement planning. Annuities versus fixed income. Which should one go for and which would suit you? Typically, annuities and bonds fall under the fixed income category. These are safer instruments than equities but offer lower rates of return. In this video, we'll explore in detail about annuities, bonds, what are the advantages and disadvantages of these instruments, and what should an investor consider before choosing an annuity, a bond, or both. Firstly, what is an annuity? An annuity is a financial instrument that is specifically used for the purpose of generating a fixed income in retirement. You as an annuitant will pay the issuer of an annuity a certain fixed lump sum. Now there are different types of annuities. This amount can be paid as an immediate annuity or a deferred annuity where let's say you are paying a fixed amount but you will reap the benefits of it let's say 3 years or 5 years or 7 years or 10 years from now on. So an immediate annuity and a deferred annuity are two types of annuities where it will depend on the need of yours to choose from. And annuities typically offer fixed sources of income, but there are certain types of annuities where this will increase with your inflation rate. Another important thing to note about annuities is that with an annuity, once the amount is paid in, you do not get the principal amount back. The principal once paid stays with the issuer of the annuity. There are certain cases where with the return of purchase price kind of option chosen in annuity, you do get it on your death where the purchase price or the principal amount of the annuity is paid back to the nominee of your choice. Secondly, moving on to bonds. Bonds are fairly simple fixed income instruments. You buy a bond and the bond pays you an interest. And on maturity, let's say 5 years or 7 years from now, the principal amount that is invested in the bond, let's say 5 lakh or a 10 lakh on which you are receiving the interest from is returned back to you at the end of the maturity period. With bonds, you also have one unique risk that you have to adhere to, which is reinvestment risk. Meaning, at the end of 5 years, if you were to reinvest the principal to buy another bond, would you get the same rate? Because with an annuity, you are locking in an annuity rate which might be more than the bond rate or less than the bond rate at the start of the annuity. But with bonds, you have to keep on reinvesting after your bond matures. Another good thing about bonds is that they offer you flexibility. After the 5-year or the 10-year period when your principal is returned back and the bond matures, you have the flexibility to maybe put this amount in different instruments of your choice. An annuity rarely ever offers you that choice. Now speaking about bonds, let's look at some of the advantages that bonds offer. The three main advantages that a bond offers you is first is fixed interest. Let's say you put in a principal of 10 lakhs to buy a bond which offers you a 10% rate of interest. That means 1 lakh you receive as a yearly interest year on year till the bond matures. The second one, most importantly, that someone requires in retirement is the preservation of capital. See, equity instruments always carry some amount of market risk. With bonds, they have utmost safety for the preservation of capital as long as the issuer of the bond doesn't default. If you go for issuers of sovereign quality, they rarely ever default. And thirdly, last but not least, you have a very important aspect that bonds provide you, which is diversification. Even in retirement, having an equity component in your portfolio is very important because as inflation grows, equity also grows either with it or more than that, giving you that booster that you need in retirement. Now, the fixed income part of your portfolio acts as a diversification because even in cases where the market falls, the fixed income part of your portfolio remains stable. This helps to smoothen out the market volatility. So, bonds offer a very crucial part in diversifying your entire asset allocation. Now, let's look at some of the advantages of annuities. First thing is you get a lifetime income. Unlike a bond where there exists some amount of reinvestment risk, annuity does not have such a thing. You lock in a rate at the inception of the annuity and that rate is there providing you a monthly or a quarterly or an annual income for the rest of your life. Immediate versus deferred annuities is the second advantage of annuities. With annuities, you either have the option to lock in a fixed rate today or you have the option to lock in a potentially higher rate in 3 years or a 5 years or 7 years from now. So if you lock in a higher rate, that means that your monthly or quarterly payments that you get from the annuity will also be higher in future. This will depend on a need of a person to person basis, so it will be highly personal. Lastly, one of the advantages that certain annuities offer is a death benefit. On your death, if you had opted for a return of purchase price annuity, your nominee will get the purchase price of the annuity on your death. This is a very important note here, because not all annuities offer this benefit. Only when you opt for a particular rider does this option become viable. Now, coming to the last question that everyone wants answered, which one should you choose? If you're someone who's okay with a lower rate of return but wants to lock in a certain rate of interest today without much kind of hassle, annuities do offer you this option. But if you're someone who are okay with the kind of flexibility that bonds offer, who wants access to the capital, let's say 5 or 10 years or after the bond maturity, or let's say you're someone who wants a higher rate of return that corporate bonds offer, then bonds will be the go-to place. Because as inflation goes up, bonds offer you that flexibility to kind of invest it either in different instrument or invest it in bonds at a higher rate of interest in the future as well. So in this video, we've talked a lot about annuities versus bonds. And as for any instrument, this will depend on your unique needs in retirement and how do you want to go about it. If you do have any questions or if you want to inquire more about this, do drop us a comments in the section. We'll be happy to answer.